Good afternoon, everyone. I'm Cynthia Tseng, partner at Fairview Capital. It is my pleasure today to welcome you to our series of interviews with thought leaders to discuss topics most relevant to the finance industry today, and also how it directly impacts the way we invest. Today, I am pleased to be here with my partner, Alan Mattamana, to discuss drivers behind the recent surge of Spac IPOs, but more importantly, how this trend will impact the private equity and venture ecosystem going forward. Alan, before we begin, can you share with our audience a little bit about yourself and also your background?
Thanks, Cynthia. Hello, everyone. I'm Alan Mattamana, a partner with Fairview Capital, and I've been with the firm for 11 years. I'm originally a chemical engineer by training, but started out with McKinsey & Company in their Silicon Valley office, consulting for startups. And that began what's now a 20-plus year career in venture capital, including several years at a late multi-stage venture capital firm based in Boston before I joined Fairview. At Fairview, I serve on our investment committee, where I participate in fund investing as well as in our direct investing activities.
Great. So when you and I sat down to discuss topics impacting institutional investors today, SPAC, which is short for Special Purpose Acquisition Company, was on the top of our list. It seems like we cannot go through the daily news cycle without reading or hearing something about this topic. And in fact, I think I read something earlier this morning. So from prolific technology investors to celebrities to athletes raising these quote unquote blank check companies, can you describe to our audience what is a SPAC? And also just more importantly, an overview of the life cycle of a SPAC from its inception through the consummation of a merger.
Sure. So I'll use this pictorial as a guiding diagram. At its core, a SPAC is a publicly listed vehicle that's used to bring privately held companies to the public markets. And typically it starts out life as a blank check company that's organized by a sponsor that's then listed on a stock exchange. And really the purpose of the SPAC is to acquire an as yet unidentified private company in a specific period of time, and that time frame is usually 24 months. So as you see on the top box here, the first step in the process is when a SPAC sponsor forms a SPAC itself. And, in turn for doing that, the sponsor's management team typically pays some nominal amount for an equity stake in the SPAC. That's called a promote, and it's usually 20% of the post-IPO value of the SPAC. And essentially what that is compensation for doing the work of identifying a target and then completing the reverse merger. The next step is when that sponsor begins a process of holding an IPO, which is kind of in the second line in this pictorial. They file an initial registration statement with the SEC. They raise capital from SPAC investors, which are on the middle left column here. And that's an area in which hedge funds in particular have been quite active, which I'm sure we'll discuss in a little bit. But in return for that capital, which is held in a trust until this target is identified, those SPAC investors get two things. They get common shares and they get warrants. And those shares are typically priced at $10 a share, and the warrants then provide additional upside. And both can be exercised, the warrants, I should say, can be exercised after the merger with the private company occurs. And I think what's important is both are freely tradable after the IPO. So that's when the SPAC has been set up. And then the next step is identifying a target private company to acquire. And, in this sense, this part of the process looks very much like a typical M&A transaction. The SPAC sponsor has typically 24 months to find their target. And after they find it, what's interesting is the SPAC shareholders have the option to redeem their shares if they don't like the investment. So effectively, if they don't like what they see, they can opt out of the transaction. Importantly, the acquisition targets are significantly larger than the capitalization of the SPAC that's acquiring them. And so there's oftentimes a simultaneous PIPE investment that occurs, which you see in the bottom left here. PIPEs are effectively public investments in private equity. And it's actually a critical part of the SPAC story, since the PIPE does a number of things. It guarantees the cash for the transaction. It also anchors the valuation in the public markets. And it can discourage SPAC investors from redeeming, which we just talked about. But the end result after all of this is you have a private company that now becomes a publicly traded company. And there's some lockup, typically about a year, when the sponsor can't trade their shares, but after that, they can be sold and provide liquidity to the sponsor. So many nuances to each step, but Cynthia, that's the life cycle in a nutshell.
Great. Well, thank you for that. That's really detailed, and you know, SPACs are not new. So in fact, you know, they're into their third decade of existence. They have experienced highs and lows, and I think we all know that in the 90s, they were known to help smaller companies not quite ready for IPOs to go public. And unfortunately, for a host of reasons, SPACs from that era produced poor performance track record. And not surprisingly, which led to, of course, a period of reputational damage. So why now? You know, why are SPACs popular again? What are some of these underlying trends driving this momentum that we're seeing, you know, with 227 IPOs raising $77+ billion? Can you please touch upon that, please?
Sure. So Cynthia, you're absolutely right. SPACs have been around for a long time, and frankly, have not had a very good reputation historically. You know, for the longest time, it was perceived as this, you know, vehicle for companies that weren't high quality enough to list via an IPO process. But they certainly become popular now. As you pointed out, 227 SPAC IPOs raising $77 billion in 2020. That's 6 times larger than in 2019. So that alone is a tremendous level of growth. But in the first 2.5 months of 2021 alone, there have been 231 SPAC IPOs raising $75 billion. So we've already surpassed the record-setting total of 2020 in the first 3 months of 2021. So what's driving this? I think it's a confluence of a number of factors. I think the first is that there's been a lack of sufficient IPOs to meet public market investor demand. And I think a lot of that demand is funneling into SPACs. You know, we know that public market multiples are historic high. And yet, if you look back, the number of listed companies today is approximately half of the number in 1996. So in 1996, there were 8,100 publicly listed companies that you could choose from. Today, that number is about 4,300. So tremendous pent-up demand for IPOs and tech IPOs in particular. I think in addition, there's also this understanding that if you want to access value creation and growth in the tech sector, you almost have to participate in the private markets. Since by the time a company goes public, the bulk of value creation has already occurred. So tremendous public market appetite for these privately held tech companies. The second is that the alternatives to SPACs, which are IPOs and direct listings, have had major issues. You know, the data suggests that the average IPO in 2020 was underpriced by over 30%. And that's based on the performance of the stock after going public. So that's a tremendous loss of value to the company. And those benefits typically go to the underwriters and their clients. And that, not to speak of the expense and uncertainty involved in the typical IPO process. You know, direct listings are better, although they don't allow you to raise fresh capital, which a SPAC does. And there's also the speed to close advantage of SPACs. You know, it can typically take 2 months from start to finish to list via SPAC versus 6 to 12 months for an IPO or direct listing. And the third, I think, is there's been this phenomenon in the last decade in the private markets where conventional wisdom was to stay private longer. There's a tremendous availability, right, of late stage capital to support you. You didn't have to deal with the hassles of the IPO process. And that resulted in just a large number of exciting, fast growing, you know, at scale, privately held tech companies who have investors that are now beginning to look for liquidity. So the supply side is also robust in addition to the demand side. And lastly, I think there's a self-fulfilling prophecy going on. We hear from our venture capital and private equity fund managers that in some cases their companies are facing a dilemma. They may not be ready to go public, but when they see their competitors accessing the public markets via SPACs and building these war chests of cash in order to compete with them, you almost have to SPAC for defensive reasons. So no single dominant reason, but rather a whole host of factors going into the momentum that we're seeing today.
Yeah, so to shift gears and talk about this and how this is impacting, the venture and private equity ecosystem across a couple of dimensions. So at the highest level, how do you think this is changing the VC and PE business model in terms of, like you just said, adding a strategy that differs from the traditional fund model? And then to push that question a little further, SPACs compete directly with VCs, especially with growth equity investors. So do you think there's room for both formats?
Yeah, I think it's fair to say that there's going to be a meaningful impact to the venture capital ecosystem. And that's a sentiment I think that the vast majority of venture capital and private equity managers we speak to and invest with at Fairview echo. But we should return to the numbers for a little bit. We know that there's a large pool of undeployed SPACs waiting in the wings. Approximately $75 billion in SPACs was raised in 2020. By rough approximation, those SPACs typically absorb companies 5 times their size. So that result equates to about $375 billion in buying power for these SPACs. And that's just a staggering number. To put that in context, that's more than all the US private equity and venture capital firms raised in all of 2020 combined. So that's just sheer volume alone suggests there's going to be an impact to the venture and private equity ecosystem. But you turn to the supply side, and we've had discussions with many of our managers, several of whom have either exited companies to SPACs or raised SPACs themselves. And there's starting to be consensus on what constitutes an ideal SPAC target candidate from a company perspective. It has to have a great story. It has to be in a visible market sector, a strong management team that's IPO ready, that can present well to public investors. It typically has to have reputable VCs in the syndicate, good customer validation. It needs to require significant capital, usually over 100 million in the near term, and is willing to take on that dilution. And it needs to determine that it's going to be easier to raise SPAC capital than it is to raise private markets capital on better terms. So all that is to say, you put that together, and the universe of investable SPACs is significantly smaller, in my opinion, than the SPAC capital that's looking to find these targets. And so what does that mean for the venture ecosystem? Well, if you are an early stage investor, this is great news. You've got a broader universe of acquirers than a year ago. They're willing to come in earlier than when a company's traditionally exit ready. And so you just have this new path to liquidity that complements the IPO and direct listing options that you've had. Now, if you focus on the later stage in venture, you can start to find yourselves competing with SPACs, particularly when it comes to the highest quality assets in the market. And so that could reduce the universe of investable opportunities that you have. Or at the very least, it forces you to deal with companies that now have different valuation expectations than before. And that can be a challenge. I think the best late stage venture funds will navigate this successfully. Some are likely to struggle, and some opportunity funds are likely to struggle as well. But all that assumes that they don't evolve. And I think many will evolve very quickly. I think the easiest path of evolution is for some of these late stage funds to become SPAC sponsors themselves. Really going out and sponsoring SPACs and holding those interests in their late stage funds, which is an attractive area to be in. And we're starting to see some of those signs occurring.
So, going now in their third decade of existence, it sounds like they will continue to be part of the ecosystem. So what are some of the issues that need to be addressed so that SPACs will, stay relevant in today's financial industry, what are some of those things that that will evolve and over time so that, we don't have another, bad reputation, damage that was done back in the 90s.
Absolutely. I do think SPACs are here to stay. That part of the ecosystem, as you said, that's not going away in the short term. But they do need to continue to evolve because there are some significant structural issues that I think all the market players need to collectively address. So the first is around performance. So, overall SPACs have had, I'd say, a mixed performance in the public markets. Kind of our research shows that SPACs have lost 12% of their value roughly in 2019, 2020. That's at a period when the NASDAQ rose 30%, so significant underperformance. But if you think about the value chain and how the incentives shake out, the SPAC sponsors did very well. And in fact, that's a very attractive place to be within the SPAC ecosystem. Because for very little capital at risk, you can raise a SPAC to identify targets, and then you've got 2 years to find a company to acquire. And at the end of that, by virtue of their 20% stake, which they obtain for almost no cash outlay, they're likely to do very well, even if the target acquisition doesn't perform in the public markets. And that just creates an incentive for sponsors to identify targets, even if the quality of the target is not up to par. So that's an interesting thing I think that the market will have to resolve. The second is, the hedge fund activity that referenced earlier. Hedge funds typically provide sponsor capital, and they are taking some early risk and backing the SPAC, but they're compensated with these common shares and warrants. And a common hedge fund strategy today is to redeem those common shares, typically at or slightly above cost, and then just build a portfolio of these warrants that are essentially free options. And so, the hedge funds in particular have had now strategies to de-risk their SPAC exposure, but that's not the case for the other participants in the SPAC chain. And so, I think there is some good news coming. Just given the sheer number of SPACs raised, there's enough market competition now that's forcing better alignment. And I think the most important alignment has to be making sure the sponsor economics are aligned with the long-term performance of the company in the public markets. And we're not quite there yet, but there's enough competition, as I said, where things are moving that way. That's going to be critical because you want to avoid this incentive to just close a SPAC deal and move on to the next one. Really want them to have skin in the game in the company that they're taking public. And we're early days in terms of regulatory response, but I think it's clear that if the industry doesn't adapt, it won't be long before scrutiny turns to building protective regulations in the space.
Yeah, no, I think that's right, and definitely the whole process needs to be more transparent and protect some of those retail investors. So turning to Fairview, I know we've done some research in terms of our exposure in the space. So can you talk a little bit about how VCs in our portfolio have utilized SPACs to create value?
Yeah. It's still very early days, but we started to see two different models. First at our underlying portfolio company level, you have a number of companies that have become SPAC. So some have already de-SPACed, via reverse merger. Others are in that de-SPACing process. But in general, the best companies today are fielding lots of calls from SPAC sponsors. And I think that's a positive for LPs in the asset class. I will say that, the most tenured of our managers are viewing a SPAC event through the lens of a financing event and not a liquidity event. And I think that's a very prudent way to look at these transactions and judge whether it makes sense to de-SPAC or not. We've also seen several venture capital managers themselves raise SPACs in the market. And I think what's positive for LPs there is that the majority seem to be doing this inside their venture capital funds, meaning the sponsor capital is provided by the fund in which the LP is already invested. And given that, I think as we discussed, one of the most attractive ways to participate in the SPAC movement is as a SPAC sponsor, those benefits should accrue to the LPs of venture capital funds. So that's a good thing. Looking ahead, hard to predict the future, right? But I think this activity will continue to increase in the near term, but you'll start to see some tweaks. I think you'll start to see venture firms raising SPACs to target companies, in their strategy. But given the time and resources involved, you probably start to see dedicated teams being hired by the venture firms, typically with ex-operators to help identify these targets. So I would anticipate more team build-outs to support sponsoring activity. And with that comes, I think by necessity, some new compensation models, tied to company-specific performance. Again, as we talked about, the alignment of incentives. But as I said, still relatively early days and certainly more to come. And, we at Fairview are going to be monitoring those developments very closely.
Great. Well, thank you, Alan, for this thoughtful discussion on SPACs. And I also just want to thank our audience for joining us today. And we look forward to bringing you new topics soon in the near future.